Suppose a bank lends money. It cares about one thing, its own profits. Now, there's a property called systemic risk, the risk that if the market, say, crashes somewhere, it's going to be contagious. Okay, and there is that phenomenon. It's monstrous, in fact. But the investor doesn't think about that. Can't. You think about your own risk. You cannot think about the cost to others of the fact that contagion may destroy a system. That's not part of your calculations. That's another externality. So the system is sort of built to magnify extremely dangerous properties. And this happens all over the place. I mean, what are called the externalities that just, dominate life. Well, those are properties that are inherent in these minimally competitive, tyrannical systems. The system has unacceptable risk built into it. It's well known among economists that markets are inefficient from the narrowest perspective. So to make it simple, suppose you sell me a car, okay? We may make a good deal for ourselves. We're not taking into account the effect on him. It's what's called an externality. And there's an effect. If you sell me a car, it increases gas prices, increases pollution, increases congestion, and that extends very broadly. These so-called externalities can be very large. Now, in financial institutions, it's far worse. They're in the business of taking risks. If they're well managed, say Goldman Sachs, they calculate the potential cost to themselves if there's a loss, but the important words are to themselves. They don't calculate in what's called systemic risk, the effect on the whole system if I go bust, and there's a huge effect. The result is that risk-taking is underpriced, meaning there's a lot more of it than there would be in a reasonable system. And so therefore it was predicted right off that when financial liberalization took place, there would be a more regular financial crises and deeper ones. And this particular one is accelerated by the fact that there was a subprime housing bubble and many other factors, so it became far more severe than anyone expected. But it's built into the system. Now, this was combined with a kind of religious market fundamentalism based on doctrines of self-regulating markets and so on, which are pure fantasy. So the regulatory apparatus was dismantled. Well, that accelerates the pace of potential financial crises. Also, and along with that came the creation of highly exotic financial instruments. Well, all of this combined, it was pretty clear in the early part of this decade that a major crisis was brewing. Alan Greenspan, head of Federal Reserve, refused to prick the bubble, as could have been done in simple ways, on the basis of religious belief in self-regulating markets. And finally, it came to this catastrophe. So this morning on the radio, George Bush announced that the government is intervening in the banks, but we want to make sure that we go back to the profit motive, not policy motives, not political motives. What are political motives? Well, that means participation of the population in making decisions. So we hate democracy. We don't want the public to be involved in decisions about things. We want to go back to the profit motive, meaning that a private tyranny, which is what a corporation is, should look out for itself, not for the public interest.